The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Treasuries sell off, equities bubble up, and the VIX near the lowest of 2025. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. Bubbling up is a perfect way of putting it.
Absolutely.
Because we're seeing a melt up here in equities with the S&P 500 now higher for a fourth straight day, gaining 0.2%. Another day, another record high. And of course, the VIX tamped down at around 15, although earlier it did get below that 15 handle. We're seeing bonds extend their losses on more evidence that the Fed can stay put when it comes to interest rates. Certainly bigger moves at the shorter end of the yield curve, the 10-year yield now at 4.40%. And the dollar getting a little bit of levity, up by 0.1%, Romaine.
Yeah, we're going to spend some time today talking about what we're seeing in Treasury yields, because with that bump up that we've seen today and yesterday, of course, on the heels of what we got this morning, fresh data showing jobless claims falling for a sixth straight week. It's a sign of resilience of the U.S. labor market, but also, and probably more importantly, a sign that the Fed really doesn't have a data-driven argument for cutting rates, particularly with the August 1st tariff deadline looming.
I think a lot of us are looking at these markets, incredibly strong credit markets, incredibly strong equity markets. And, there's a temptation to think, well, maybe tariffs don't matter. Maybe everything that's been happening just kind of doesn't matter in the face of all these other positive forces.
And for now, those positive forces indeed outweighing the negative, with the S&P on track for its 13th record close of the year. And that includes 10 all-time highs in the past 4 weeks alone. JP Morgan's trading desk, they're expecting a 14th record, even a 15th, maybe even more before the year is out, amid still strong economic data and market technicals that they say make it difficult to be short. However, there's always an asterisk, and some strategists out there say a reversal could be imminent. Deutsche Bank pointing to how much investors are borrowing to buy stocks. A margin debt measure at the NYSE that soared 19% in the past 2 months. That's the fastest bullish re-leveraging since late 1999.
All right, so definitely something to watch out for. Yet for now, strong corporate earnings plus that resilient labor market you talked about, it all adds up to less immediate demand for havens like U.S. Treasuries. Here's the benchmark 10-year yield, and you can see the red channel here highlighting that move higher on the back of lower prices these last 2 days. Now, today's catalyst, of course, was fewer people filing for unemployment benefits. Weekly jobless claims have now fallen for the longest stretch since 2022. Yesterday's catalyst, expectations that more trade deals will be announced before August 1st following a Japan agreement and signs of progress with Europe. Romaine, both of these factors will directly contribute to the Federal Reserve's assessment of the economy as it gets ready for next week's policy meeting.
Absolutely. And right now, as you look at the 10-year at 4.449 right now on the longer end of the curve, Alex Petrone joins us to kick us off to the close, head of fixed income at Rockefeller Asset Management. Alex, great to see you.
Good to see you. Thank you.
When you look at yields, and more importantly, I guess when you look at the economic data, are yields in the right place? Are they headed in the right place?
They feel like they've moved towards the right place. We've seen a significant steepening of the curve. I think investors are now finally being compensated appropriately for long-term risk. You've entered into a bit of a range, and investors are asking where's their value on the yield curve today.
Is that value going to be tied way more directly, or the change in value, I should say, going to be tied more directly to what's going on in the labor market, or is this a market that is still focused on inflation and the potential reaction by the Fed to it?
I think we're focusing on every single data point. So what happens with the Fed, what happens with labor, what happens with inflation, certainly. I think there are spots, what we see investors focusing on is, are there spots in the market that have underperformed either treasuries or spread products in corporates? And what we're really focused on is look at the underperformance you've seen in the municipal market and then take a step back and ask where that's coming from. And that's really coming from technical factors unique to that market, where supply has been very robust, up 15% year over year. Demand is positive, but hasn't kept up. So you can take a step back and say, in those environments where munis might underperform treasuries or corporates, is that a buying opportunity? And then you start to look past some of the noise day to day of the leading economic indicators, jobs, what have you, and you say, is there still value to be had? And we think yes.
When you take a step back, you're clearly a bonds person, but I'm curious how you look at what's happening in equities. The S&P 500 and NASDAQ making new highs on what seems like a daily basis, the meme stocks mania returning, largely resilient corporate earnings as well. What does it tell you about the sentiment out there, the appetite for taking on new risk, the mindset with which investors are evaluating the daily noise, whether it's trade headlines, whether it's economic data, and wagering on how the Fed proceeds?
It tells me when equity markets continue to run and the data is a bit muddy and spirits are running high, it tells me that bonds people, fixed income, we are important as a ballast in your asset allocation. As we look at equity valuations at seemingly all-time highs, you have to take a step back and look at yields within the fixed income market and say they're compelling, and maybe they're a good surrogate for some of my equity exposure today. And you could look to spots like the high yield municipal market. You look at the index today, it's yielding 5.95%, tax exempt. If you're a US tax-paying investor, that has historically been a compelling entry point. And then you look further at other key data points, such as starting yields, tend to be a really key indicator of 5-year forward returns. 5.95. 10% tax equivalent yield. I think bonds have a lot of value today, particularly as equity valuations continue to rise.
I like that relative comparison. I guess when you, again, take a step back and look at the headlines and try to make sense of everything that's happening, do tariffs no longer matter the way that we thought they did? Because President Trump is now talking about 15% tariffs, and the market or investors in general are kind of absorbing that, like, yeah, okay, that could be the new minimum baseline. 15% is the new 10%.
I think we anticipate that the economy behaves immediately. It doesn't, right? We're seeing some signs of tariffs impacting inflation through goods. We're seeing today with the labor data, job creation is at a low, kind of signaling towards those pre-recessionary levels. I'm not calling for a recession by any means. Manufacturing data shows some softening from here. So it might just be a matter of we haven't seen it impact markets yet.
I do have to ask you about the Fed and Fed independence and all of the issues swirling around whether Jay Powell might be on the outs, and if he is on the outs, the complexion of who would take that seat. Is that a worry for you at all, or is this more just kind of a media creation, and from an investor perspective, it's sort of like shoulder shrug?
From an investor perspective, critically important. From a market's perspective, we've seen the market react to this thought that the Fed might be less independent on a go-forward basis. I think we have to pay attention to the fact that no matter what the headline might say day in and day out, Chair Powell's term will be up, and then you start to ask, should we anticipate a more dovish Fed on a go-forward basis? And then questions we ask is, what does the term premium look like? What is appropriate if we see a Fed that starts to ease further in the future?
When you look at, let's just say corporate debt for a second. I mean, we're kind of in the middle of a pretty strong rally this year in corporate debt, and a lot of that is also a supply-demand issue. If we were to get some type of Fed shock with regards to either Powell being removed earlier or some other sort of meddling in their independence, what do you think the impact would be in the corporate yield space, not necessarily just in Treasury yields?
In the immediacy, spreads could widen. Right? Think of some of the events that we've seen when spreads are at all-time tights as they are today, and it very much is technically driven factors, tremendous demand, limited supply. But when you see spreads at all-time tights, you're almost looking for a reason to say, well, spreads should widen out from here. And in those environments, you take a step back and you say, is this a buy opportunity? Candidly. Yeah,
that's the buy the dip moment. Alex, I always love it. I love talking to you, always looking up for the silver lining. Alex Petrone, head of fixed income at Rockefeller Asset Management, kicking us off to the close here on this Thursday afternoon. A lot of activity in equities, a lot of activity in the bond market, and a lot of activity in commodities. When we come back, we're going to talk about how Trump's trade talks are pushing oil prices higher. Natasha Kaneva over at JP Morgan joins us in just a second.
And from an outlook on oil to an outlook on real estate, we'll discuss where the growth markets are and how data centers are pushing hundreds of billions into the sector with Michael Levy, CEO at Crow Holdings.
And I'm glad you brought up data centers, because a little bit later in the program, we're going to talk about how AI is fundamentally changing the world we live in and the way global businesses operate. We're going to talk about that with the co-CEO of one of the businesses that's already seeing those changes. All that and more coming up in a bit. This is The Close on Bloomberg.
Let's get you a broad check on commodities. We see oil prices rising and gold taking a bit of a breather as those trade talks progress, bilateral trade talks that the U.S. is holding. We're also going to get color from metals giant Newmont Mining when it does report earnings after the bell. In the meantime, I want to get another expert's view on the asset class. Natasha Kaneva is head of global commodity strategy at JP Morgan. Great to see you, Natasha.
Thank you for having me.
So I look at oil prices, and they've been in a bit of a holding pattern over the past month, right? WTI between 62 and 66, Brent between 67 and 71. And I mentioned the trade talks. We seem like we are getting some progress on that front, which helps support prices and can, of course, when resolved, support demand. What does the supply picture look like right now in oil?
So there is a lot of supply coming in. So it's definitely this is visible. You can see this in the inventory built out. So year to date, the inventory is built by about 180 million barrels. But what is interesting is that majority of that was built in China. So why that's important? Because China is absolutely not critical for the price formation. Yes, WTI, that's the Cushing inventories, the Brent, that's the European inventories. But out of this 180 million barrels of built, only 40 to 50 million is actually in the OECD countries with the visible inventories. The rest is in China. The argument the market is making is that if it's in China, it stays in China, who cares? And that's one of the reasons why the price has been in a holding pattern, as you absolutely mentioned. So supply is increasing, inventories are building going into the second half of the year. We do believe that inventory build will happen even more. But because today we estimate that the Chinese inventories are about 95% full their storage. What that means is that at some point, this inventory build will start showing up in the visible inventories in OECD countries like United States and Europe.
And when it does, that might be a surprise to market. Is that not priced in right now?
No, at the moment it's not priced in, so there's a very strong support to the price at around 68 for Brent. This is not priced in. The inventories will start showing up, but again, the market doesn't know what indeed the storage is. Like, we believe that in the case of China, their storage is very close to capacity, but there's a lot of arguments that actually they have been building out a lot of storage capacity. They're trying to mimic exactly what United States have. We have about 2 billion barrels of storage capacity. So if indeed China has significantly more storage capacity, they can continue taking this oil and storing it and just keeping it away from the world.
Remind me, what's going on with our storage capacity here in the United States? Have we made an attempt to actually start to rebuild this petroleum reserve?
So the petroleum reserve is just one part of the picture with about 400. The maximum capacity is about 700. We had money allocated in the beautiful bill, about $1.3 billion. Now this is gone. Right now the allocation is about $170 million. So this story is already now done. In the case of storage, Cushing is at about 21 million. It's very, very low, and the inventories are near depletion. In the case, inventories of products are near depletion. For example, diesel inventories are it's the lowest since 2005.
So if we start to see a buildup in inventories, whether it's in the government's reserves or in just the industry reserves, that's downward pressure on prices?
Downward pressure, correct.
What do you see as the potential upward pressure? Is there anything that you're seeing out there that could maybe actually move prices in the opposite direction?
So I think the second support to the prices have been a very, very strong performance of the product prices. You can see this in the margins, you can see this in the cracks, you can see this in the spreads. The inventories are very, very low. In the case of United States, very low. Why is it important is because, as we discussed with you guys, we're already almost in August. We will be entering winter season with no inventories of diesel, and that's exactly when the demand spikes. So inventories in OECD countries outside the United States are very low, the product inventories as well. So one of the bullish arguments is the crude market, the crude prices, cannot collapse or cannot go substantially lower as long as the product prices stay very high. So that's one of the bullish arguments to make, which is a strong argument.
Okay, so clearly volatility is pretty muted right now, but as you mentioned, there's going to be some headline risk coming up in September, right? You have President Trump's ultimatum to Russia to strike some kind of peace deal with Ukraine expiring. You also have a new EU price cap on Russian oil kicking in. What do you think positioning will look like? Have people started to stake that out, or is that to come?
No, volatility is low. You know, the bias is towards the puts, you know, a more bearish bias in the market. We actually believe that the position is pretty neutral at the moment. A lot of that, it's, you know, it's summer, it's a slow season, you know, people on vacations, but you absolutely are correct. We have a lot of event risk. All of that is concentrated in September, at the very beginning of September. I think it's very easy to dismiss, you know, for example, President Trump's threat on Russia, you know, given his emphasis on low energy prices domestically in the United States. But recent history shows us otherwise. Yes, President Trump gave Iran 60 days to negotiate. On day 61, United States and Israel attacked Iran. So because of that, I personally do believe that there is a low risk of disruption in Russian flows, but it's not negligible. So we have to keep this in mind. European price cap, again, it kicks in on September 3rd. Again, my personal opinion is low probability Russian volumes will be disrupted. But again, there's usually a lot of volatility involved with implementations of those price caps. And the third point I would like to make is the sanctions on Iran. the UN sanctions that, the snapback provisions that could be activated on September 3rd. That's another risk that we should be keeping in mind.
Okay, so there are all these risks, yet it feels like there's a bit of complacency in the market right now. People are pretty calm and they see like a support for prices overall. What is the one thing you worry that is not priced in that could happen before the year end?
So we're watching China very closely. So this is economies that is actually performing surprisingly well. So you can absolutely see this in the commodity prices. Iron ore is again above $100. The steel margins are doing really well. But at the same time, refining capacity. We discussed that we're entering winter with very low amount of inventories. United States refining is operating at about 95% capacity. China is operating at about 70%. So we know that they imported a lot of oil. We know that they're going to increase refinery runs. So the question is, are they going to export all those products or are they going to actually stockpile them? All the feedback we're receiving on the ground is that actually China will stockpile, so which means indeed we will be entering winter with very low levels of inventories globally.
All right, Natasha, I have to leave it there. Natasha Kaneva, one of the best in the business, head of global commodity strategy over at JP Morgan, as we continue to count you down to the closing bells with one of the biggest movers on the day to the downside, American Air, a drop of about 9% after the company said it's not quite seeing the full travel rebound, at least here in the U.S., as some of its competitors are. We're going to talk to a key analyst who covers the stock coming up after the break. This is The Close on Bloomberg. All right, let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we start off today with Birkenstock. Goldman upgrading to buy. The analyst hopeful despite a tougher consumer outlook and the risk of tariffs, but says she expects Birkenstock to still be able to take market share from rivals. Those shares up about 2% on the day. Next up, Spotify. Oppenheimer raising the audio streaming company to outperform, setting a price target of $800, with the firm seeing, quote, many tailwinds, and says that the company has a significant opportunity to monetize ad users. Those shares up 2% on the day. And finally, General Dynamics. Wolf Research upgrading the defense contractor to outperform. The move following the company's latest results that featured a, quote, good top line and bottom line beat. The share is nevertheless down about 0.6% on the day, and those are some of our top calls. Now, we do want to stay in the aerospace sector and take a good look at the consumer side of it. American Airlines shares having their worst day in at least 3 months. This after scaling back their earnings outlook amid a slump in consumer demand. Stephen Trent covers American as equity analyst and managing director at Citi. He's got a buy rating on the stock, and he joins us here in studio too. When you saw the earnings, I know we weren't as concerned about the earnings from the past quarter and more importantly about the guidance. A reinstatement of guidance, but a reinstatement that was certainly below what the street was looking for. Did that surprise you?
Definitely, it was a little bit of a surprise, and thank you for having me on. I think that 3Q is really the place that took people back a little bit. So does this really mean that the long story is broken? I would absolutely not say that. They generated $2.5 billion in free cash flow for 6 months of the year. They still expect positive free cash flow next year. You've got tailwinds for 2026. But July was a tough month. They had 5,500 flight cancellations, and that is very costly, not only in terms of the revenue spill, but the extra cost from having to put crew members up and that kind of thing. So that was somewhat surprising.
With regards to the demand side, and we've heard this from the other airlines about the idea that overall travel is resilient, but when you sort of break it down into geographies and different sort of income segments of the consumers, things are a lot more layered. And I do wonder what American Airlines' exposure is relative to its competitors who seem to be a little bit more bullish on the future.
Yeah, so I think that longer term, the company is still constructive, but absolutely. If you have, think about it, like the upper echelon of travelers, Delta and United really have very good anchors to that premium passenger flow. Maybe the next run down, you're going to have American and perhaps an Alaska Air. And then after that, we start dealing with the low-cost carriers. So Southwest Airlines, for example, having a big miss today versus American's EPS beat. But certainly in terms of the anchor to premium travel, American's getting better, but they're not quite back to where they should be in terms of managed business travel. So that is a piece of the pie they're trying to improve, but it's a long process.
I'm so glad you brought that up, especially when it comes to premium and the managed travel business, because corporate travel in particular seems to be the issue, right? American says it remains flat, while United and Delta have indicated that it's leading the rebound that they're seeing. How does American propose fixing this? Because, that managed travel part has been kind of an issue for a while.
Yeah, absolutely. So there are some things that are going to be a little challenging to change. Certainly, when one looks at American's hub strength versus Delta and United, their focus of influence, their strength in their hubs is geographically not exactly the same as a DAL or UAL. So there are some things there, all else equal, that are going to be challenging from a comparison perspective. And then when one also considers the amount of metal that United and Delta have on Trans-Pacific and Transatlantic, that's also a bigger piece of the pie. And those lucrative routes, that's a segment that American serves, but they're not as big in it. So I think as American moves forward, I think they keep doing what they're doing, re-engaging with business travelers, maybe all else equal, pulling back from some domestic routes that are less lucrative. And that's how they at least start to, continue to close the gap.
You should tell them at some point, too. They need to update their policies with regards to their lounges. It's very onerous.
Did you get turned away again?
Yes, I got turned away from a lounge.
Romaine takes this very personally when he gets turned away.
I do, and I'm sure it was personal.
Oh, I highly doubt that, because I've been turned away as well. Let's talk quickly about Southwest. It also cut its guidance after second quarter earnings miss, but it put a price tag on the tariffs of about $1 billion. Was that surprising that they were able to pinpoint it like that?
A little bit. And I think in the case of Southwest, you definitely have a couple of moving parts. I would say a more complex, in fact, a far more complex situation than you have with American Airlines. So for one, they did finally put some clarity on 2025 guidance. What concerns me going forward, not only the impact they see from the tariffs, but they are actually expecting a big sequential improvement in EBIT in the fourth quarter. So this is an airline that's banking on a lot. And if you look at the likes of United and American, for example, they actually have conservative sequential RASM improvements 3Q to 4Q. Southwest is on the opposite end of the spectrum, and they're burning cash, unlike American.
And they're also, they have a new buyback program that's pretty substantial as well. Stephen, always a pleasure. Stephen Trent is equity analyst and managing director over at Citi. Coming up on The Close, we'll speak to Michael Levy, the CEO of Crow Holdings, about what areas within real estate he finds attractive. Maybe the office sector is one of those. This is The Close on Bloomberg.
Yes, we need these large language models like a Gemini or an OpenAI. We need the chips that the NVIDIAs of the world create, but we need this physical infrastructure. We need the data centers where we've been the biggest investor in the world. We need the energy where we've also been a huge investor in generation, in transmission, in utilities. Both of these things in the physical world are hugely important.
Blackstone President John Gray speaking on Bloomberg earlier today about their investments in data centers and utilities on the heels of those earnings. Welcome back to The Close, 3:30 p.m. here in New York. Romaine Bostick alongside Scarlett Fu.
And I feel like everyone's talking about data centers, whether you're a hardware company, whether you're an investment firm, it's all the rage.
Yeah, whether you're an Uber driver. I mean, I'm not even joking. I mean, it's like you get into an Uber, you tell people you work for Bloomberg, and they start asking you immediately about AI and data centers and all this stuff. I don't know if that's a sign that we've reached a market topper now. Remember in the old days, like if it was like, what was it, like at the shoe shine guys giving you stock tips?
Yeah.
You know the market's overvalued.
Okay, well, I mean, I keep hearing about it over and over again and again on conference calls that's coming up. So our next guest is another guest who's talking about data centers. He says we're also witnessing a gold rush in data centers as investors chase these new development opportunities. So let's bring in Michael Levy now. He is CEO of Crow Holdings, a national real estate investment and development firm. Gold rushes are great for a while they last, but they don't last forever. And at some point, you know, the house of cards kind of falls apart. Give us a little more scope on this gold rush into data centers right now. I know you have a lot of conversations about this. Is it a big part of what you do right now?
It's a small part of what we do right now, but we're active in the space. Big picture, 5 years ago, a big data center was 25 megawatts, maybe 50 megawatts. Today, a big data center is 500 megawatts, a gigawatt and a half. you're talking about critical infrastructure, massive 1,000-acre campuses. And so the game has changed. The demand, things like autonomous vehicles are coming and the amount of processing capacity. So the fundamental demand is there. And it is being chased by technology companies, power companies, real estate companies, infrastructure companies. And I don't know what the total dollars is, but it's certainly $1 trillion of capital chasing these opportunities. And you look at that, and there are risks here that people need to pay attention to. You know, there are 4 risks. One is the delivery of power. I mean, if you're a power transmission company for a part of the country, and let's say I'm making numbers up, but you're delivering 50 gigawatts today, you probably have a queue of people wanting 150 gigawatts behind it. And most of those folks think they're going to get the power. So the delivery of power is a risk. The second thing is the durability of tenant demand. A lot of this demand is also being driven by the big users, the OpenAIs, the Oracles. Well, and they're spending tens of billions of dollars on this. Won't at some point in time they perhaps pause leasing, and so you have a concentration of tenant demand. The third thing that people are worried about is obsolescence. You're building these buildings, some of them in a cornfield in Nebraska. At the end of the lease, what are you going to do? Is the demand going to be there? And then the fourth risk is the takeout vehicles. Everybody wants the development returns, right? But ultimately, tens and hundreds of billions of dollars of data centers are going to be built. And the way they're going to generate those returns is to sell them into more of a core market that it wants more of an infrastructure-like return. That scale of that market doesn't exist today. So there are things to be cautious of. At the same time, it is truly unprecedented demand. And if you're in that business today and you've been able to get positions at attractive pricing, there's a lot of money to be made.
Okay, so it's a part of your business, but it's not a huge part of your business.
Correct.
Where would you rather be then in this current environment, given where we are in the economic cycle?
I think there's 2 setups right now in the marketplace that you're hearing some people talk about, and that is in the traditional apartment business and the traditional industrial business. What you're seeing today is demand, supply, delivery of supply, going back to things that were started in 2019, 20, 21, that are at very high levels. And that very high level of supply has resulted in relatively low rent growth, or in some markets, rent declines. But what's happened at the same time, new starts have collapsed. You're seeing declines of new starts 25 to 75% down from the peak.
Why?
Because capital dried up. What happened is January 22 came by, inflation went up. People looked at the real estate sector and said, oh, okay, wait a minute, I need to be careful here. And development being on the leading edge of that concern, and so capital dried up for new development. And so now when we look out at 26 and 27 for deliveries of industrial real estate, and when we look at 27 and 28 for delivery of apartments, there's very little delivery of new supply going to happen. And so you're going to see significant rent growth.
But you're seeing so many, at least when it comes to rental, or really just any kind of housing right now in major cities. You're seeing so many municipalities and their city councils and the state legislators really clamoring for companies to come in and bid. Are you getting the support, though? I mean, it's one thing for a mayor or a governor to hold their hand up and say, we want this. It's another thing to say, we're going to offer some incentives that's actually going to lure these people here and get them to build.
I think that, New York City's done something about office convergence, and some markets have put incentives. But the issue is even at a more local level. It is the local planning groups that stand in your way. It's the really local folks from an entitlement perspective that limit your progress. And in America, the decisions aren't made at the state level, they're not made at the federal level, they're not even made at the city level. They're made at the very local level. And that NIMBYism is alive and well across the country.
Is that shaping where you look for investments geographically around the country?
We have been we come in America from Dallas on out, and so we've been very comfortable in the Sun Belt for a really long time. That's where America's growth is. Any way you look at it in the past and when you look to the future, America's moving to the Southeast and Southwest. I spent 50 years of my life in New York. I'm a born New Yorker, but I've been Dallas 10 years. You just sit in Dallas, and the growth is unbelievable as corporations and people move there. And if you want to make money in real estate, invest where people are moving to.
So you said starts dried up because capital got more expensive. We might see an interest rate cut at some point soon. Is that going to re-inject capital? Oh,
I think capital is already beginning. What happened was, people pulled back and thought there would be distress in the real estate market. Well, that distress didn't happen, all right, other than the office sector. And so capital's already beginning, what I just said, capital sees. And so capital is beginning to move back into, and it's more the equity capital than the debt capital. The banks are available, the banks are open. In general, that is not the problem today. It's equity investors seeking returns. And if they think they can buy a distressed building for, let's say, a 15% return versus starting a new development project with a 15% return, they'll pick a distressed building. But those opportunities aren't out there.
With a lot of the investors, though, that are looking for alternative asset classes outside the mainstream ones, have they started to push real estate to the side a little bit in favor of some of these new alternative asset classes? Real estate used to be the ultimate alternative asset.
Beginning in January 22, real estate, which had been running, once the interest rate environment changed, once it was very clear we had inflation, fund flows to the sector really declined. And we've had the lowest fundraising markets that we've had since the GFC in the past couple of years. So real estate definitively has been, for the past few years, moving towards the bottom in terms of preferred asset classes. That is beginning to shift, but I still think America's fascinated by AI and technology and growth and infrastructure. And so I don't think real estate is in the top of the pecking order right now in terms of attractiveness, but we'll see.
Things change, and
things
we've
will
seen this
change
in the past. Mike, always a great conversation. Michael Levy is the CEO over at Kroll Holdings. As we continue to count you down to those closing bells, when we come back, a closer look at the deal now confirmed. Union Pacific and Norfolk Southern. You see the moves in the stock. It's our stock of the hour, and it's coming up next. This is The Close on Bloomberg. Time now for our stock of the hour, and it is Union Pacific, the U.S. railroad, down about 4.5% after all the speculation about a potential tie-up in the railroad space. Now confirmation that UNP has been in discussions with Norfolk Southern about a combination, a market cap combined that would top about $200 billion, marking potentially the largest merger of the year. Lee Klaskow joins us right now, senior logistics analyst over at Bloomberg Intelligence. There's been talk for a long time, Lee, about potential consolidation in this space. I know we're still a long way away from a formal deal, but does this make sense to you?
I mean, from a practical standpoint, it makes complete sense. I mean, to have a transcon railroad that connects the East Coast and the West Coast, it'll limit the number of times that a rail car is interchanged. Every time a rail car is touched within a rail network, it not only complicates things, but also it adds costs and adds risks of, injuries, if you will, from that exchange. So, it does make sense, but, there are regulations out there when it comes to rail mergers from the Surface Transportation Board, and they're high hurdles because there were rules set up in 2001 to kind of limit further consolidation of the industry. The last major deal was Canadian Pacific buying Kansas City Southern. That deal closed with the STB, I believe, in 2013, and Kansas City Southern was exempt from those rules because they were the smallest Class 1, and the combination of CPKC they're still the smallest Class 1 rail. So, this is very different. This is the number 2 and 3 rail that could be combined.
Okay, so, regulatory holdup might be an issue here, or it feels like it's definitely going to be an issue. What about other stakeholders, like, for instance, the labor unions? Have they said anything about this? How big a source of resistance do you expect them to be?
I mean, there's a lot of stakeholders involved. There's going to be some shippers that are going to be for it. There's going to be some shippers that are going to be against it. I would imagine the unions might be very apprehensive about it because, obviously they don't want their jobs to be eliminated. I guess the good news is that Norfolk Southern went through a major cost-cutting period a couple of years ago when they started to embrace precision scheduling railroading, and so there's not a lot of we call it meat on that bone, if you will, to cut. So it might be more, the cutting could be in the corporate offices, whether it's accounting or other roles that are kind of in office buildings versus the people that are in the front line actually running and operating the railroad.
Any potential regulatory issues, Lee? I know that might be a dumb question given the current administration, but anything that you would keep an eye on?
Yeah, so the STB is holding some hearings in August about how to cut regulation out of the rail industry. Given President Trump has been a big fan of reducing regulations and trying to make some industries more competitive, the STB is holding some hearings on that. We don't know if that's going to include their merger rules, so it'll be interesting to see what comes out of that. This is going to be a long process. Even if the two parties come to an agreement on a price, it could be 2 years from the regulatory standpoint until the deal actually closes and that a transcon railroad is operated. And it's important to note that if this deal actually does get announced and they do agree on a price, we wouldn't be surprised to see a Burlington Northern CSX deal, because both of those railroads could be at a disadvantage from a competitive standpoint.
Yeah, they'd have to get together for defensive reasons at that point. Lee, thank you so much. Lee Klaskow is senior logistics analyst at Bloomberg Intelligence, and the prospect of a big railroad M&A is just another sign that things are not, I don't want to say frothy, but getting feeling kind of toppy in this market.
Yeah, I think everybody's looking to see whether there is that canary in the coal mine, whether it's the big meme stock trade or the big pickup in M&A. Some of it makes sense, maybe some of it doesn't. But I do, and it's funny you bring that up, and we talk about an S&P at a record high, fourth straight day of gains. It's like the longest win streak we've had in a couple of months, and this idea that the market, at least right now, just does not see the risk, or at least does not seem to want to worry about it right now.
Absolutely. Trade deals or no trade deals, everything's moving forward.
Yeah.
All right. We're going to take you to the closing bell with David Bahnsen, CIO of the Bahnsen Group, coming up next. This is The Close on Bloomberg.
As we look at equity valuations at seemingly all-time highs, you have to take a step back and look at yields within the fixed income market and say they're compelling, and maybe they're a good surrogate for some of my equity exposure.
Alex Petrone over at Rockefeller Asset Management kicked us off to the close just about 50 minutes ago, Scarlett. And as we wait for those closing bells, we should also just alert our viewers, the President of the United States scheduled to actually go to the Federal Reserve building in just about 10 minutes time to ostensibly tour these renovations that they've complained about being too costly. But more importantly, Jay Powell will be there, at least according to the president, to greet him and to aid in that tour. A relatively unprecedented visit. I mean, this would only be the fourth time a sitting president has actually set foot into the Fed building.
Yeah, and of course, he wasn't scheduled to go, but he's now joining this, and it's become a bigger deal as a result. And of course, the FOMC will be announcing their decision next week. Not that anyone's expecting a rate cut on Wednesday, but this is kind of all.
Does Trump know that? Okay.
Trump thinks it's possible, and he says it's possible. All right, let's take a look at how things are shaping up, right? Because you have the S&P and the NASDAQ 100 pretty much at record highs. For the S&P, it's a fourth straight day higher. But within the indexes, what's interesting, of course, is some of the individual movers. Autos are all down, but really dragged lower remain by Tesla, with Elon Musk trying to change the narrative from falling car sales to AI to robots.
Absolutely, and that's been a big part of this story. Also, keep an eye on shares of Sarepta. I know we don't have it on the screen, but shares have been halted repeatedly after a 22% plunge. David Bahnsen joins us right now, the CIO over at the Bahnsen Group here in Studio 2. And David, when we talk about a market that has, it looks like we're going to set another record high, I think our 12th of the year, 13th of the year, if I'm keeping track right now, at a time where I think a lot of people are saying maybe we shouldn't be at record highs, given all the material potential risk out there, whether it's tariffs and economic policy, Fed policy, who knows what's going on geopolitically with all the wars and other things we have going on right now. Where do you see valuations? Are you comfortable with them right now?
I'm not comfortable with valuations, but I think that's very different than the price level. When people talk about all-time highs, I always point out every price the market's ever been at was an all-time high until it wasn't because we made a new one. It's valuations that are the issue, and that is an area of sensitivity. The macro circumstances you bring up, you look at Fed, you look at uncertainty, you look at tariffs. I'm one who believes there's always something. It's just that those are different things, quarter by quarter, year by year. But if it wasn't those things this year, it would be something different. There's a bullish case to be made in the fact that earnings growth has been double digits 2 years in a row. That's not normal. That's a good sign that we expect at some point easing in monetary policy. We got through a Fed tightening cycle and didn't break the market and didn't break the economy. That's a good thing. The issue is 23 times forward earnings, that there just mathematically isn't a lot of room to go. And a lot of the big cap companies, mega cap companies that have carried it, I don't think people have done the math of what has to happen for them to continue generating these types of returns.
But you know, you've heard the bull case with those big tech companies. The idea that this AI thing, it's structural, it's going to generate more productivity and just generate new sources of cash flow, an addressable market in the trillions and trillions. You don't buy that?
Well, I think that most of these things are priced in, but you have to apply it. Are we talking about the companies that make AI, that make the chips, the infrastructure? You know, I grew up learning how to be a professional investor through .com, and the only companies that really were making money were the kind of plumbing companies behind the scenes, and some of them that are still in business are still not back to 1999 highs. They've made money. It's just the valuations were that high as an entry point. I worry about that for some of them. But I also want to point out that in that bull case you referred to, the CapEx that is being spent is a revenue to NVIDIA. It's an expense to somebody else. And no one exactly knows what the ROI is going to be in the end. I'm not comfortable with that thesis carrying the entire market at those valuations.
Yeah, and that could take years to really decipher and strip out. So you talk about the valuations being a concern, but the S&P 500 is so market cap weighted, right? And so we're really talking about Mag 7 names and a couple of AI adjacent names. You strip that out, how does valuations look for the rest of the S&P 500?
What's amazing is it's 16 times, which is basically about the S&P multiple for 30, 40 years. So it really is a concentration in the companies that have done best that have the frothiest valuation. So it really argues for a sort of risk weighting adjustment. Look, people have been talking about going to even weighted versus cap weighted for a long time, and that trade hasn't played out. For us, we're bottom up dividend growth investors, so we get to be more agnostic. But I certainly would recommend people favor something more defensive and lower beta and more reasonable valuation. And then when you get the dividend on top and get to measure your valuation through ongoing dividend growth, I think you have something a lot more sustainable than just hoping for ongoing multiple expansion.
What are the common traits of those dividend growing stocks that have reasonable valuations going forward? I mean, where are you finding them in pockets of the S&P 500?
Well, and because we're bottom up, it isn't that we're looking into certain sectors, but there are plenty of names in consumer staples, in energy, in financials, and health.
In financials as well.
Oh, absolutely. In financials, by the way, you're actually getting incredible performance right now. You look at Blackstone today has been one of the great dividend growers the last 15 years, but also from a total return standpoint, it's unbelievable. When you go from 200 billion assets under management to 1.2 trillion in a decade, that's explosive growth in free cash flow generation. That business scales very well. But even on the bank side, JP Morgan is one. What a phenomenal dividend grower it's been, and the stock price has just followed the dividend growth.
Do you have any interest in some of the, I guess, fintechs, for lack of a better phrase, kind of, I guess, the new banks?
Meaning the PayPal type names? No, we don't. I mean, look, they're at very high valuations. They're not consistent free cash flow generators. They're high capital intensity. And so they'll grow up one day and become dividend growers, and then we get to look at them. But we tend to like companies when they become more boring, and they're still in a little bit more growthy phase.
I saw Pepsi on the list of things that you're interested in. I mean, that's, boring, not as an insult. But
it's a big compliment. Boring in my world is a compliment.
Yeah, okay.
Yeah, and I think Pepsi's an example of a name that is down on the year, and there's a lot of things that are up and frothy, higher valuation. Pepsi's got a very reasonable multiple, and eventually you see the dividend growth. The management has a lot of confidence in their ability to turn things around. And both the snack business, beverage, water, very diversified global company.
Absolutely. David, always a pleasure.
Thanks.
David Bahnsen, Chief Investment Officer with the Bahnsen Group, counting us down to the closing bells. Just about 3 minutes until we get there, Scarlett. And we talk about a market I think overall could probably be called boring today here. I mean, not a whole lot of movement in equity prices, not even a whole lot of movement in treasury prices, despite the fact that the directions are in different areas.
Absolutely. And it's yet another day where the S&P 500 hasn't gained more than 1%. I mean, it's been this slow melt up all along. Yesterday counted as a big rally, and the S&P only gained 0.8%.
But isn't that kind of a good thing? I mean, some people would argue, like, what's better? Do you want sort of this grind higher, or these incremental gains that take you to record highs, or do you want it all in one fell swoop where in 3 or 4 weeks you just go from 0 to 60?
We know what the day traders would say.
Right, the day traders. But I mean, isn't that healthier? I mean, in theory, the idea is that those gains would be more sustainable?
Yeah, people would say that, but of course it could take any kind of headline at this point that could, send everything tumbling. And we might just get some of those headlines today when the president goes to the Federal Reserve to take a tour of the Fed and the renovation that's taking place there.
Yeah, we're going to keep an eye on that. We'll bring you full coverage as soon as that happens. Also, quite a few earnings scheduled across the wire after the bell, including from Intel, Newmont, Boyd, Weyerhaeuser, Deckard's, and, of course, Sam Adams.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostic here with Scarlet Fu, taking you through to that closing bell with a global simulcast. It's already started. There's Carol Masser in the radio booth. There's Tim Stenovic right by her side. We'll see them in a second as we welcome our audiences across all of our Bloomberg platforms, including our partnership with YouTube. It took us a while to get the shot up, and then Carol was still trying to get that last strand of hair in place here. Carol, what are you looking at?
You're not supposed to tell my secrets.
Yeah.
I mean, come on. Obviously, we're thinking about the chip sector in a big way. Intel reporting after the closing bell. Listen, they are continuing to work on their turnaround. We just talked with our Kunjan Sabani, said the foundry is so crucial to the business, so that's one stat that we have to keep an eye on. But also said that he has the CEO, about 18 months to kind of pull it together. So clock ticking on this one.
Yeah, I was saying the Intel turnaround story has been
18 months?
18 months to kind of figure out and at least make the sentiment change. I know.
Okay, yeah, that's quick.
I said I do not envy Lit Bhutan's task ahead of him. I mean, we've had how many CEOs at this point? 3 CEOs try to turn around this company in recent years.
Mm-hmm.
Yeah, it's a tough go there, but I mean, he knew what he was signing up for. And of course, as we await earnings, we also want to get a sense of what demand looks like for those companies that are at the white hot center of the AI revolution too. Intel might very well give us some kind of picture, even with its specific problems.
Yeah, and I'm also interested in some of the other earnings that we're going to get. Deckers, maybe provide the footwear company, maker of Hoka's and Uggs, that can maybe provide a little bit of insight into.
It's like a window into your closet, Romaine.
Yeah, it's Uggs, Birkenstocks, and Hoka's.
He's a big fan of those three brands.
Yeah, you know, I love ugly shoes. Just throw some Balenciagas in there and I'll be all set. The closing bells here in New York as we await those earnings. Green across the screen for the major indices. Though the Dow, a big laggard on the day, down more than 300 points or 0.7%. We should point out the S&P 500, relatively unchanged on the day, but it's still higher by roughly about 4 to 5 points. That's going to be good enough for the 13th record high of the year. The NASDAQ Composite at a fresh record high, up about 40 points or 0.2%. The NASDAQ 100 up 0.3%, and the Russell 2000. That's your major laggard on the day, a drop of 31 points or 1.4%.
All right, quick check on the S&P 500. Kind of an even split, although a little bit more to the downside. 286 names, Scarlet, to the downside, 216 gaining ground on this Thursday.
And the sectors are tilted to the downside as well. Consumer discretionary, which includes car makers, which includes Tesla, leading the way lower by more than 1%. Materials and healthcare also weaker on the day. On the flip side, energy stocks gaining 0.75% as oil prices rise. Tech and communication services also finishing in the green.
All right, guys, as we await earnings, some of the individual gainers, of course, Google, Alphabet, up at its highs 4%, finishing the day with about a 1% gain. As we know, the key point, Alphabet, talking about AI demand. I'm going to toss it over to you, Romaine, because we got Intel crossing.
Intel earnings crossing the wire right now. The company says that for the second quarter, it did see a significant contraction in its gross margins, down to 29.7. The street was looking for 36.6. The company also saying that for the second quarter, it's reporting revenue that did beat estimates, $12.86 billion. The street was looking for roughly about 11.8. And I believe the bottom line, the adjusted loss per share for the second quarter, 10 cents a share. That's wider than what the street was looking for. Here's your guidance going forward for the third quarter. Revenue, here's the range, 12.6 to $13.6 billion. The street was looking for 12.64. So basically the bottom end of the range is relatively in line with what the street was looking for on average. The company says that it does plan to proceed with job reductions that should account to about 15% of its total workforce. The company also saying that it says that some demand that it has been seeing as of late, guys, is, quote, a buy ahead, meaning maybe a bit of a pull forward in some of that demand.
So just looking at the press release, what's notable here is after the quotes where we got some of those highlights that you mentioned, Romaine, is the first subhead is progress on driving greater efficiency and execution. I think that gives you a sense of the theme here that Intel is working with, right? They need to prove that they're making progress. The CEO in particular is making progress with cutting costs and streamlining things to get this company in a position to be able to benefit from an upswing. They
mentioned about $1.9 billion in restructuring charges. Also kind of interesting too here, that foundry business, the real foundry business that everybody's concerned about, a slight beat on revenue, guys. 4.42 billion. Street was looking for 4.39.
On the capex side of things, the company said it's ending planned projects in Germany and Poland, also saying that it's slowing progress when it comes to Ohio. So that's one thing to keep an eye on too.
Interesting, yeah.
Yeah, and I mean, going a little bit more deeper into the press release, Lip-Bu Tan, the CEO of Intel, talking about laser focused on strengthening their core product portfolio and our AI roadmap to better serve customers, also taking the actions needed to build more financially disciplined foundry. And again, just going back to what our Kunjan Sabani said of Bloomberg Intelligence, so important, he said, to Intel's future outlook is what they do at the foundry and growing that business.
Yeah, and it's kind of interesting, too. I mean, I'm just kind of going through this, and it looks like some of the upside that we saw in the most recent quarter was from a little bit of a rebound in those PC sales. We should point out the data center business did beat slightly, $3.94 billion, as did client computing at about 7.87. But Intel products revenue overall came in at about 11.8. So you definitely, and that's been the concern, right? This idea that as they try to transition more to AI and more to these other services, how do they do that with a legacy PC business that we know had been in decline? But at least for right now, that legacy PC business still holding up. So maybe that provides a bit of a bridge for Tom.
And I'm so glad you point out the legacy business versus a part of the business that they want to highlight, the data center and AI revenue, because gross margin for the second quarter, the adjusted gross margin, was below 30%, 29.7%. Analysts were looking for 36.6%. So that's a big miss there, especially on profitability.
All right. Well, shares of Intel right now higher by about 3.1%. Starting to get some numbers out of Newmont right now. The company's second quarter sales came in above estimates at $5.32 billion. Estimates for $4.9 billion. Newmont's second quarter attributable gold production coming in at 1.48 million ounces. The estimate was for 1.39 million. Shares in the after hours right now higher by about 1.3%.
All right, I want to go back to Intel because we are seeing the stock continuing to trend higher. I'm looking at our Ian King out with his right through. Right now, Intel shares are up 6%. So Street certainly feeling like maybe Intel's starting to deliver on some of the changes that it's been making. Our Ian King reporting that it gave a stronger than anticipated revenue forecast for the current period. Third quarter sales expected to be $12.6 billion to $13.6. And just talking about, as you pointed out, Romaine, company benefiting from that resurgence in the PC industry. Still some challenges, including lost market share and a struggle to attract customers to its foundry business. Again, so important to the company's future.
All right, we're going to continue on Intel, but just want to give you an update here on Deckers. Those earnings crossing the wire. The shares up 10% in the after hours trade, a 17% jump in net revenue in the most recent quarter to $964.5 million. That is a beat on the top line number. On the bottom line, EPS coming in at 93 cents a share. I don't really have a comparison for you to analyst estimates, but you see the share reaction there. Pretty healthy revenue growth in the most recent quarter, and for some investors, I guess that's good enough.
Yeah, I'm looking at the breakdown here of the brands. Romaine's favorite brands, Hoka, those net sales increased almost 20%.
What?
UGG sales increased almost 19%. However, the other brands decreased 19%. So it's very much a tale of different brands here at Deckers.
The crazy thing about that is, yeah, go ahead.
Oh,
sorry.
I was just going to say, I mean, it's clear that Hoka and UGG are powering this company. I mean, the other brands, Teva included, down 19%. Hoka bringing in $653.1 million in revenue. UGG bringing in $265.1 million in revenue. Which of those two is your favorite?
Neither, and you know that, and I assume that the Hoka thing was up because of Katie Greifeld, and the UGG's revenue was up because of Scarlet Food's closet. But also, I was looking at the geographic breakdown. 49%, 50% jump in international net sales compared to a 3% jump in domestic net sales.
There's that weak dollar at work.
Yeah.
All right, I'm going to go back to Intel.
Okay, go back
you guys
to
continue talking about. I'm just looking at Ian's story, Ian King's. Just in terms of what we're thinking about in terms of employees that are going to be there, it looks like, forgive me, I lost my place. Layoffs will reduce staff by about 15%, and the company does expect further cuts through attrition and the splitting off of business units. This came from the CFO, David Zisner, in an interview with Ian. And so they're looking to end the year with about 75,000 employees. That's down more than 20% from the end of the June quarter. And keep in mind that Bloomberg News has been reporting this out, that they were looking to cut their workforce by roughly that amount. So it looks like they are delivering on what they had said.
Intel also adds that it sees restructuring substantially complete by the fourth quarter of 2025. So we might get another couple of kitchen sink quarters here, but by first quarter of 2026, when the earnings start coming out, that's when we'll start to see evidence of improvement.
All right, we're going to continue with our earnings coverage as several big companies are reporting, but we're also keeping an eye on President Donald Trump being greeted right now at the Federal Reserve by Jerome Powell. amid all of the conversations about how much they've been spending to renovate the Eccles building. Let's take a listen.
A long time, and you're in charge of the committee.
Indeed. One of the reasons why we wanted to see it was the overruns of the expenses. We wanted to figure out why.
Yeah. So we're taking a look, and it looks like it's about 3.1 billion. It went up a little bit, or a lot. So the 2.7 is now 3.1.
I'm not aware of that.
Yeah, it just came out.
Yeah, I haven't heard that from anybody at the Fed.
Yeah, it just came out.
Our notes had it about 3.1 as well.
3.1,
3.2.
This came from us?
Yes. I don't know who does that.
You're including the Martin renovation. You just added
our entire capital.
Yeah, you just added in a third building is what that is. That's a third building.
Well, no,
the
but
Martin building.
it's a building that's being built.
No, it was built 5 years ago. We finished Martin 5 years ago.
It's part of the overall work.
But it's not new.
So we're going to take a look. We're going to see what's happening, and it's got a long way. Do you expect any more additional cost overruns?
Don't expect them. We're ready for them, but we have a little bit of a reserve that we may use, but no, we don't. We expect to be finished in 2027. We're well along, as you can see.
Nice to take these off every once in a while when we're not under too much danger. So, any questions?
Mr. President, does the issue give you as a real estate developer, what would you do with a project manager who would be over budget?
Generally speaking, what would I do? I'd fire them.
Do you think this issue, Mr. President, gives you cause to do that?
Well, I'm here just really with the chairman. He's showing us around, showing us the work. And so I don't want to get that. I don't want to be personal. I just would like to see it get finished. And in many ways, it's too bad it started. But it did start. And it's been under construction for a long time. It's going to be a real long time because it looks like it's got a long way to go.
Yes, sir.
So,
President, are there things the chairman can say to you today that would make you back off some of the earlier criticism?
Well, I'd love him to lower interest rates. Other than that, what can I tell you? The country is doing really well. I just briefed the chairman on the deal we made with Japan. Japan is putting up $550 billion in order to lower their tariffs a little bit. That way they have a little bit lower tariff. And they also opened their country to free trade, which nobody thought was even a possibility. And we get a zero tariff in the free trade. We don't pay tariffs, and they're going to pay 15% on everything they send into our country. So it's great. But they put up, as you could call it, seed money. Let's call it seed money. You could call it anything you want, but it's a total of $550 billion. So nobody thought any of that was possible, and it's wonderful. And we're doing pretty well with the European Union, likewise. And we have some others. They're all really big, and our country's going to make a lot of money. We would be helped if interest rates would come down, but we're going to see how the board rules on that soon. I'd love to see them come down a lot. But we have a country that's thriving. We had a dead country 1 year ago. Today we have the hottest country anywhere in the world. And we'll get this one finished.
Mr. President, do you
Thank
think
you.
that Jerome Powell's a numbskull?
And we're watching the President of the United States there, Donald Trump, alongside the chair of the Federal Reserve, Jerome Powell, walk up those stairs, followed just behind by the senator from South Carolina, Tim Scott, touring the renovations that have been going on at the Fed building for quite some time. Renovations that, of course, have now become a political hot-button issue because of the alleged cost overruns based on Bloomberg reporting. That cost now over $2 billion. Though there was a pretty curious exchange at the start there where the President of the United States citing cost overruns at maybe approaching the $3 billion mark, a little bit of a disagreement by Powell on exactly where those numbers came from and, more importantly, where those numbers might go. Bloomberg's Catarina Sariva joins us right now. She covers the Fed for us down in Washington. We should point out this was a pretty historic moment on a lot of levels, Catarina. You don't see a sitting president walking through the Fed building very frequently, and in this case, obviously, a construction zone. The optics of it, standing there with Jerome Powell, the disagreement over whatever money is being spent, and of course, the little quip at the end there about the need, in Trump's view, to lower interest rates.
Yeah, that's right. I mean, as you mentioned, it is quite historic. I think the last time a president was present at the Fed was in 2006 when Bernanke was sworn in as chair. And before that, it had only happened rarely. So it is not something you see very often. And that's obviously because we like our central bank to be independent. Most developed countries have this. And so that kind of keeps the optics of that going. And yeah, I think, like you mentioned, he, of course, got in the quip about lower interest rates and kind of referenced the Fed's meeting. The next one will be next week. So we're getting quite close to that.
I am curious about just this idea of pressure on the Fed. I mean, there has been clearly a coordinated effort by this administration to, I guess, poke holes, if you will, in, if not the credibility of the Fed, certainly the credibility of Jay Powell. And I'm wondering, from your view, as someone who covers monetary and economic policy like no other, is this having any sort of material impact on the way people are viewing what the Fed might do next in the direction of interest rates, or has that not happened?
I don't think it's happened yet. If you look at expectations, next week, virtually no one expects the Fed to lower interest rates. They have themselves said that is very likely not going to happen next week. And they've kind of kept pointing to probably in the fall we'll see some, and that's where the markets are pricing things as well. So it hasn't really had an impact yet. The only place I would say it has had an impact is that you see the two Trump appointees on the Fed board as making remarks now saying they're kind of, they're in favor of lowering interest rates pretty soon. So we may actually see dissents from them next week. But that it won't change the big picture, right?
It won't change the big picture. But there is some concern right now about just how this is received by financial markets, even if there isn't a change, just the idea that that pressure is there. Earlier today, we got a jobless claims report, Catarina, 6 straight weeks where we've seen that number suggests that cutting rates right now in the face of what seems to be a still resilient labor market, at least from a strictly data-driven perspective, just doesn't make sense. When you look at the economic data, and particularly look ahead to a week from tomorrow when we get the next monthly jobs report, is there any evidence in the economic data where you can make an argument for cutting rates?
Economic data, right? I mean, economists famously like to say, on the one hand you have this and on the other you have that. So there are different ways you can interpret things. And I do think that when you look at the labor market, absolutely we are in a, what some are calling a low firing environment. We have not seen mass layoffs. It kind of appears to be chugging along. But it's also a low hiring environment. So we're not seeing a lot of demand for labor right now. We're not seeing companies hire a lot of people. We're seeing it take longer for people to find a job when they are laid off or when they quit. So there are some signs that could be interpreted as kind of early signs of weakness or just signs of fragility, right? And interest rates are still at a level that most people consider at least somewhat restrictive. So you can make a case for lowering rates a little bit. I don't know if you could make an economic case right now for lowering rates 300 basis points, like what the president is asking for. But certainly, Fed officials have said it'll likely be appropriate this year to lower rates a little bit.
All right, Catarina, always appreciate you stopping by for us. Bloomberg's Catarina Sariva, who covers the Fed for us here at Bloomberg. We want to bring Claudia Sahm into this conversation right now to get her thoughts here on the optics of what we just saw there. And I hope I'm not making too much of this, Claudia, but this seemed to be a pretty extraordinary moment just to see those two men standing next to each other. The shaking of the head is some disagreement over whether they were spending $2.5 billion or $3 whatever billion. But overall, just the idea that you have two men who I would think have a relatively decent working relationship, at least going back to 2017, that now appear to be at odds.
Right, well, it is an extraordinary moment, and yet, the Fed should be open to transparency. I mean, if this is information that the president wants to learn about, that's part of the Fed. Well, that's part of its accountability to the public. So what we're seeing today, this isn't necessarily, this certainly isn't a problem. I mean, this is what the Fed is there for, to be transparent. It's more a question of where this goes from here that might be of concern.
Is the pressure that we're seeing, it's not just from Trump. I mean, we've heard from most of Trump's surrogates. I mean, just yesterday, Howard Lutnick making the case that Powell needs to go. As we speak right now, Scott Bessent, the Treasury Secretary, is on another network, again, talking about how the Fed's mission has gotten too broad and it needs to be reined in. When you look at the Fed's mission, and I don't mean just the mandate as explicitly laid out in Congress, but the tax that it has taken on its own in service of that mandate, does it appear to be too broad to you?
It's at the discretion of the Fed. I mean, it has to be accountable to Congress, the roles that it's been given. I mean, the dual mandate is extremely important, and it's a very broad mandate. Price stability, maximum employment. There's a lot that you need to know about the economy, know about financial markets to really make good on that. So I think it's, the Fed is given the resources, the ability to kind of take its best judgment and, perform it. But it's something, the Fed should not be above criticism. It is fine to, and I'm sure they do, review and think about what the decisions they're making, how they're allocating their resources. But we have to be really careful about the political influence. The White House in particular shouldn't be dictating what the mission of the Fed is. That's not how this works.
There are critics out there, Claudia, and I'm just going to play devil's advocate for a second, that have actually said that the Fed itself has actually politicized things. Some of the examples they give, sort of these speaking tours, listening tours, I should say, that Powell sort of engaged in, even the communication that Bernanke started with the press conference. There are a lot of people who look at that and they say, isn't that just kind of politicization? Maybe not to the extreme that we're seeing currently out of the administration, but is that not kind of just a different side of the same coin?
Well, again, part of the deal with the independence of the Fed in performing monetary policy is they have the discretion to, perform that to the best of their ability. If individuals are really concerned, I mean, Congress created the Fed, Congress created the institution, and it has and can continue to, adapt and change that institution over time. I mean, and it is very important that the Fed isn't partisan, but it's going to make decisions. I mean, I've been critical of some Fed decisions. I mean, it's never going to please everyone, nor should it. I mean, that again is why it is so important to have these protections around the Fed that allow it to be independent and make those kind of decisions.
There's the theory as well that whether Powell stays and more importantly, whoever his replacement is, I know the market's speculating that no matter whoever would replace Powell would in theory have to be way more dovish than Powell is. But I've also heard it positive by investors on Wall Street that once that person is confirmed and they're behind closed doors, that basically, the economist in him or her is going to take over the stewardship that they're supposed to have over this organization and listening to the ideas of the other Fed members, that will take over. And no matter what political pressure is going on outside the building, once they're inside those walls, that they will stay true to their mandate. Do you believe that?
That's certainly what I want to believe. We'll see, right? It's unfortunate that a lot of the discussions and the president, suggesting that he's only looking at people that want to lower interest rates, like that sets up a really tough environment to, see the candidates that are out there as being independent and being, as you said, coming into the institution, working with the other members, having a consensus, building forward. I think we can still absolutely have that. It's unfortunate that we're in a place where it's so hard to even talk about the Fed now without taking, political side. That's really not the place that we want to be in. But we certainly can come out of this, right? We're down a path that is looking pretty worrisome, but we, could change of leadership and, go in a direction that really kind of rebuilds the Fed. I mean, anything is possible at this point, but it's disconcerting.
Let's set aside the current political dynamics for a second. I am curious just about the general structure of how the Fed operates and the use of rate cuts or rate hikes, rate setting as the key policy tool, and whether you think in 2025 that's still the most effective way for the Fed to go about shepherding the economy.
Their interest rate policy, it's been an effective tool that the Fed has used for decades. It's not to say there are times where, we've seen a real shift in how the Fed conducts monetary policy and how they think about, the tools that they have. And we've seen, tools after the financial crisis using the asset purchases. I mean, the Fed has broadened its toolkit also. So I don't think there's anything to say that the interest rate policy is something they should put to the side. But we should remember, and I think we've certainly had a lesson of this in recent years. I mean, the Fed has basically one key tool with monetary policy, its influence over interest rates, and that is not a cure-all for everything that affects the economy. So I think, this reminder that while the Fed has this important job, it has tools to do that. It can't solve all the problems of the economy on its own.
There have been some proposals floated, the idea that maybe there should be a revisit of the Fed mandate, or certainly a revisit of some of the changes that were made back in 1951 that gave the Fed even greater independence. Would you be supportive of the idea of exploring that?
In the United States over history, as well as around the world, we just have countless examples of close coordination, explicit coordination with the central bank and the government as leading to higher inflation, right? So it's just the idea, and particularly in a time where, President Trump has talked about he thinks the federal funds rate should be like 1%, not, over 4%. That would be a very dramatic change in the economy. And again, the historical record on that kind of coordination, where the Fed now has a job of keeping interest rates low, to keep borrowing costs low, like that sets us on a path to inflation that would just not be consistent with the dual mandate the Fed has right now. And it's just, we don't need to relearn that lesson. That did not go well, to have that kind of explicit coordination.
With regards to the renovations, and I know that it's kind of the renovation and the overrun in budget is kind of being used more as a political cudgel. Let's face it, there's not a construction project in history that didn't go over budget. But do you think it's possible that Congress could use that as a way to maybe try to at least exert more control over the Fed's budget, if not Fed policy itself?
Right. So the independence of the Fed, it requires safeguards. There have always been political influences that tried to take control over interest rates. This is nothing new. One of the safeguards that's very important is the fact that the Fed is in charge of its own budget. It doesn't use congressional appropriations. It basically has its own funding source. And that means, they were able, the board itself could approve this renovation. It approves its operating expenses. And yeah, that can come with some cost. If you have no budget constraint, you're probably going to spend some more. Now, they are accountable to Congress, so it does keep things held in check. But if the Fed, from this process or just in general, were to lose that independence funding, that would open it up to all kinds of, outside political interference. And we've seen a lot of examples of that recently with other institutions.
All right, Claudia, really appreciate your insights. Always great. Claudia Sahm there, former Fed economist, now over at new Century Advisors. Joe Mathieu, the co-host of Balance of Power, standing by right now. And Joe, just to keep this conversation going, I don't know if we could put that video back up, but it was an extraordinary moment to see Powell and Trump standing next there. Of course, Trump talking about $3+ billion in renovation costs. Powell shaking his head, not quite sure what numbers he's citing, what buildings he's talking about here. What did you think about when you saw that?
I won't say unprecedented because we overuse that term, but this is the only fourth time, as we've been saying, that a president has made tracks down the street to the Eccles building at the Federal Reserve, and to see the two of them together in hard hats. He thought he was, I guess, going to sneak up on him in front of the cameras with that piece of paper. But Jay Powell immediately turned him around and said, this number, you've added a whole other building here, Mr. President, which appears to be where that $3.1 billion number came from. They're not done, Romaine. The president, just so you know, has a podium set up outside the building in the middle of what looks like a hairy construction site. There are cones everywhere and concrete and the whole thing. He's going to stand there and take questions from reporters. So he may not be done with the messaging yet. Remarkable, though, that Jay Powell showed up. I mean, they're literally walking through a construction site. This could be on HGTV.
Yeah, I mean, there was a lot of questions as to whether Jay Powell would actually be there. Just real quickly, Joe, we only have about 30 seconds. Why was Tim Scott there, the senator from South Carolina?
Well, you've got the head of the banking committee there, who's, of course, I guess going to be helping to toe the line here on excesses when it comes to the Federal Reserve. And it's not just the senator, the director of OMB is there and some other officials. The Fed chair was the one that kind of popped off the page when we saw that he was going to be showing up in person, Romaine.
All right, we're going to continue to cover this story here on The Close. And of course, Joe Mathieu will be at the top of the hour with Balance of Power with even fuller coverage of any comments that the president makes. Stick with us. This is Bloomberg.
It looks like it's about 3.1 billion. It went up a little bit, or a lot. So the 2.7 is now 3.1.
I'm not aware of that.
Yeah, it just came out.
Yeah, I haven't heard that from anybody at the Fed.
Yeah, it just came out.
Our notes had it about 3.1 as well.
3.1,
3.2.
This came from us?
Yes. I don't know who does that.
You're including the Martin renovation. You just added
our entire capital.
Yeah, you just added in a third building. Is what that is. That's a third building.
Well, no,
the
but
Martin building.
it's a building that's being built.
No, it was built 5 years ago.
An incredible timeline that we're living in right now. An extraordinary moment just moments ago with the President of the United States and the President of the Federal Reserve Chair, I should say, meeting there in that construction zone going on right now at the Fed headquarters in Washington. A lot of concerns right now about some of the cost overruns that have become a political football. We're going to get back to that story in just a second. And at the top of the hour, the Balance of Power team will take over, and they're going to have even a deeper dive into that meeting between two of the most powerful men in the world and their disagreements now at play. But we do want to turn our attention back to financial markets and, more importantly, back to earnings. We just did get our earnings report out of Intel under the new CEO, Lip Bhutan. Intel, surprising, believe it or not, to the upside. Better than expected reports or results for the most recent quarter and guidance going forward that, at least for right now, is giving investors maybe a little bit of confidence that maybe, just maybe, things might be turning around. Matt Bryson joins us right now. He's Managing Director of Equity Research at Wedbush Securities. And Matt, I know Tan has only been on the job for since late March, April, or whenever it was. So he hasn't had a lot of time to do anything. But based on the numbers you saw today, based on the idea that the PC business seems to be holding up for now, do you think that Tan is going to have enough of a runway, enough of a bridge to implement the changes he wants and at the same time keep investors happy or at least complacent while he does it?
I mean, it's really hard to say, Romaine. So I think that a lot's going to depend not on what they just gave us or what they guided to, but what you see with their next set of products, which really start in Q4 when you get Panther Lake out. Yeah. And so I think that's what everyone's watching. And that brings them into 2026.
Yeah. Hey, Matt, just 1 second. We have to go back to the President of the United States speaking right now down in Washington. Hang on one tight.
Expensive for about $200 million. And that was a big hotel, big project. It's the hottest in the world right now, but the one section, people are pretty much unable to buy housing because the interest rates are too high. We have no inflation. We have a lot of cash coming in. The tariffs have been unbelievable now. People that didn't even believe in tariffs are saying, what a great move that was. We have hundreds of billions of dollars coming in. Japan, just on one deal, is paying us $550 billion. And they opened up their economy. It's incredible, the deal. And they're happy, we're happy, everybody's happy. But we should have the lowest interest rate of any country, and we don't. We should have. Every point is worth $365 billion. So we want to get the rates down, but we also want to get the Fed building finished. So I met with the contractors, we toured it with the chairman, and we had a very good tour, and we'll talk to you about it sometime. But Tim and I, we sort of understand what happened.
Yeah. Too expensive. Bottom line is this, that Americans deserve to become first-time home buyers. President Trump has created the best economy in the world. The one thing that would make it better is lower interest rates. Full employment is even more possible. Wages rise faster as interest rates come down when your employment is at 4.1% because of your leadership. We have revenues coming in at record-breaking, maybe last month even more revenue coming in than bills going out, which is remarkable.
They found $26 billion. They said, where did that come from? Nobody, I think that's been many, many decades since that happened.
I can't remember that.
They found $26 billion last month, and they said, where did that come from? I said, why don't you try the tariff? Said it was true. We took in We're taking in hundreds of billions of dollars, and our country is doing great, and we have no inflation, and the numbers, the job, everything is good. The one thing we have to do is get housing prices down and the interest rates down so people can buy the house, because they're all making money, but they can't get the interest rate down. We have to.
Amen.
All right. And he's been my friend for a long
You've been
time.
on a number of construction sites. Did you see mismanagement going on or funds that aren't?
Well, I see a very luxurious situation taking place. Let's put it that way. And I was given a very nice tour by the head of construction. And, you know, look, if you look over here, they're trying to open up the basement. When you open up a basement, first of all, it's the worst space. Always a basement is the worst space in a building. And it's also the most expensive space to build. And especially here because you have a water line. You know, they're going down into the water, so they have to build a reverse, what's called a reverse bathtub. The water has to be kept out. It's very expensive construction. So it would have been good if they didn't build it. Would have been good if they didn't do certain other things. If you look at the kind of protection in the hall, have you been able to get in the hall? You saw the protection of plywood. I mean, that was a lot of money just to protect it for a period of time. I would have done it very gingerly and easily and not have to spend, you know, millions of dollars on protection. And there are things that could have been different. Look, there's always Monday morning quarterbacks. I don't want to be that. I want to help them get it finished. It's been going on for years, and I want to help them get it finished. And what we really want to do, and I think I can speak for Tim, and I think I can speak for the entire Senate, we can speak for everybody, frankly, is we want to see interest rates come down. Our country is booming, and the interest rates is a final little notch. And if you look at Europe, they've lowered 11 times in a short period of time. We've lowered 0. And, you know, they are competition, although we're in the process of probably making a very good deal with them, too. They want to make a deal very badly, very badly. So we're making a deal. We just completed our deal with Indonesia. We just completed our deal with the Philippines. We're making unbelievable deals, and the money is pouring in. We want to get interest rates down.
But on interest rates, at some point, does the level of interest rates now slow economic growth?
Yeah, it never helps it if it's high. Never helps it. Well, it's already as good as we're doing. Think of how well we'd be doing. We'd be like a rocket ship. As good as we're doing, we'd do better if we had lower interest rates. And we should. We're prime. Don't forget, without us, the whole world collapses. So we should have the lowest interest rate because, you know, you can talk about Switzerland, you can talk about wonderful countries, no debt, but without us, everything collapses. We should have the lowest interest rate. And if you took it down 3 points, not a little bit, but 3 points, if you got us down to 1, we would save more than $1 trillion, basically with just a paper transfer. Without us, everything collapses. We should have the lowest interest rate. And if you took it down 3 points, not a little bit, but 3 points, if you got us down to 1, we would save more than $1 trillion, basically with just a paper transfer. You wouldn't be cutting costs of anything. You wouldn't be building anything. Just a move of the hand saying we're going to lower interest rates. You would save $1 trillion a year. And there's nothing you can do to save that kind of money. Well, we had a little talk about it, and I thought it was a very productive talk. He'll be able to tell you at his next meeting, but I will say that he did say the country is doing really well. And the country is really doing well.
Mr.
President.
Yeah, please, go ahead.
How would you describe your talk with him? Would you say that the energy was tense? You know, did you come
No, I didn't think it was tense. No, I thought we had a good meeting. No, there was no tension. There was no tension. I think he had more tension with my great senator to the right. He's a pretty tough cookie. He was, you might say.
Bottom line is we had an honest, candid conversation about some of the overruns at this building. We had it in my banking committee, and he said we were wrong, and turns out we were right. Thank God President Trump and his team took enough time to dig into some of the details, and the details are clear. We need to get this project done. We would like to keep it where it is or a little lower, but at the end of the day, the point is that instead of talking about interest rates, instead of talking about first-time home buyers, instead of talking about the heat in our economy, that's a good thing, we're talking about an overrun on the Federal Reserve building as opposed to the Federal Reserve objective of lowering and keeping our economy full.
You know, as an example, they built parking spots under a building next door.
Really expensive.
That's very expensive. When you're starting to build parking lots, underground parking lots, that's a very expensive thing. A lot of people I know, they park their car and they walk a block or 2 blocks or something. But it is a very expensive thing. But that is what it is, and that's okay.
Is this project a fireable offense?
What?
Is this project a fireable offense for Jerome Powell?
Look, I would love to see it completed. I don't want to put that in this category. It's a very complex thing that could have been made simple. I built a great hotel, and the great hotel that everybody in this group knows very well, it's called the Old Post Office, and it's a much bigger project than this, and I spent $200 million building it. And it was taken down to the steel, for the most part, taken down, you know, you've seen it go up. And I built it quickly, and I built it for $200 million. That was a much bigger job than this. Spent $200 million, and it's got marble bathrooms, the top fixtures, the best of everything, all brand new. So, you know, this is a very expensive job. I don't know. It got out of control. And that happens. That happens. It's a shame.
Are you negotiating on auto tariffs? Your auto tariffs.
No, I'm not negotiating on auto tariffs.
Does EU looking at 15% like Japan?
Well, it depends. What Japan did is they brought down their tariffs. They gave us $550 billion because they didn't want to pay 20. They were 28%. And they gave us $550 billion up front. 100%, 500. We get 90, they get 10. 90%, they get 10. And there's no payment. It's not a loan or anything. It's a signing bonus, I call it. But they gave us $550 billion and took down the tariffs a little bit. And then they agreed to open their economy to everybody. This was not easy. This took, you know, a lot of people walked out of rooms and things. Sometimes they walked out of rooms, went back to Japan. Right. I said, where are they? They went back to Japan, and then they called and they said, can we make a deal? They came back a couple of times. This happened. This was, as you know, it was over a period of months, and ultimately they agreed to open their economy. Now, the opening of the economy is worth more than $550 billion, the payment that they made. It's worth more. So between that and the payment, we reduced it down to 15%, but they were at about 28%, and then they bought it down, basically.
But could other countries buy it down?
Yeah, I would let other countries buy it down, sure.
Mr. President, do you feel better or worse about your relationship with Fed Chairman after this meeting?
I feel good about it. I mean, look, I have one dispute, and the dispute is there could be some things with money and, you know, where it comes from, how it's come from, how it's printed, where it's printed, all of the standard things with the Fed. But I just want to see one thing happen. Very simple. Interest rates have to come down. If the interest rates don't come down, we're knocking it out of the park with high interest rates. If interest rates come down, then that final little element kicks in. That's housing. And the sad part is that people, wonderful young people, young couples starting off, they can't get a mortgage because the rates are too high. Tim knows that better than anybody, I think.
Mr. President, if the rates are hurting families in the country, why let that keep going for another 8 months? Why not just fire them?
Because to do that is a big move, and I just don't think it's necessary. And I believe that he's going to do the right thing.
Do you have a name in mind?
I believe that the chairman is going to do the right thing. I mean, it may be a little too late, as the expression goes, but I believe he's going to do the right thing. The fact is, it's so big what's taking place in America, where the king of Saudi Arabia says you have the hottest country anywhere in the world, and I thought you were dead 1 year ago. I thought we were dead. I just left NATO, as you know. They're agreeing to pay 5%. We're not paying anything. We send them the equipment. They pay for 100% of everything now for the war, Ukraine. But I just left NATO, and every one of those leaders said, every country, they said, and very smart countries, very successful countries, frankly, and every one of them said you have the hottest country in the world. We did that over a period of a year, less than a year. I mean, if you think, less than, they say a year ago we were dead, and today, so I'm here 6 months, and we did it over, and we had the help of men like this and people like standing right behind me. They're
leadership
great.
Matters.
They're great professionals. They really are. They're great professionals, and in a short period of time, we made it the hottest country in the world. With all of that being said, we'd like to see. We can always do better, and we can do better if interest rates come down. Right? Good job you do. You do a nice job. I watch you a lot.
Thank you. I appreciate that, Mr. President. Do you have a name in mind to replace the chairman?
I do.
Or one person?
2 people. maybe 3.
Any clues?
I'd pick him, but I think he's not leaving the Senate.
No, sir, I'm not.
I'd pick Tim. Thank you. No, there's no pressure. No. We want to have, his term comes up soon. I think he's going to do the right thing. Everybody knows what the right thing is. Even people that believed in, the higher rates, they're all on board. They all want to see the interest rates come down. It's very important.
Mr. President, if he doesn't do the right thing and cut interest rates, as he said, will you then consider?
I don't think we're going to do that. I don't think so.
Investigate the newly declassified documents like ever.
Yeah, that's a terrible thing. I have great respect for Tulsi and the documents they found on President Obama. Frankly, it was an Obama thing, but it was the people that worked under him also working with him. And no, it's a very, very serious thing. Thank you very much.
Thank you, Mr. President.
Thank you, everybody.
President Donald Trump there walking through the construction zone just outside of the Federal Reserve building in Washington, a visit ostensibly about some of the cost overruns that have taken a project that was supposed to cost roughly about $1.9 billion, now at around $2.5 billion, maybe upwards of $3 billion, depending on whose numbers that you believe. We should point out that the president did say that he does not necessarily think this was a fireable offense. He said to fire Powell would be a big move and is, quote, not necessary. Of course, he did reiterate his call that he does want to see interest rates drop and says that we could be doing a lot better, meaning the country, if we had lower interest rates. And he says that overall, his meeting with Powell went well. Joe Mathieu is the co-host of Bloomberg's Balance of Power, and he joins us right now. And Joe, a meeting, a tour, I guess, if you will, seemed like it lasted, a little bit less than 30 minutes. And the discussion that he had after there, standing there with Tim Scott, he talked, of course, a lot about lowering rates, a lot about Powell doing the right thing, but he did not necessarily talk about removing Powell.
Yeah, you got right to the news. That was the moment. Is this a fireable offense? He made clear that it's not. But I'd go a little further into the conversation to a line that he repeated a couple of times, Romaine. I believe that he's going to do the right thing. He said that several times. I believe he's going to do the right thing, almost daring Jay Powell to not lower interest rates at the next meeting. And of course, nobody expects that he's going to do that. So the president seems to think, or at least is projecting, that he can still convince Jay Powell to lower interest rates rather than have to fire him or pressure him to step down. A lot of people thought that might have been the motivation for this visit today. Apparently, he did have a much chippier conversation with Senator Scott. I'd love to be a fly on the wall for that conversation. But they seem to keep coming back around housing prices. We need to lower interest rates. Nobody's getting fired here today. Yeah. I think this was much more of an optical exercise when it comes to politics.
Two interesting comments that came out, and I'm glad you brought up the issues or whatever potential issues came up between Powell and Senator Scott that Trump alluded to. Trump also said two things that sort of struck me. A, the idea that there was, at least in his words, some sort of meaningful discussion about interest rates. Something that we, of course, know, at least by tradition, is something typically you do not see. But also this idea when he was asked about who would replace Powell, and he kind of mused that he had a couple of names in mind, maybe 3. Any idea what he's talking about?
Well, in terms of replacements, we hear the same short list on a regular basis here, whether it's Hassett or Warsh or Scott Bessent himself. But how about the body language as well? Before they went behind closed doors to talk about interest rates, and I can't imagine what those who try to promote Fed independence think of these two alone in a room together having that talk today at the actual Fed headquarters. He kind of shoved him. He gave him a jab in the arm when he said, I just want him to lower interest rates, when he was first asked if he thought that Jay Powell should be fired. So it makes you wonder if there was a breakthrough today. Was this more of a jocular affair? Did they actually find some common ground as two men in front of the cameras, Romaine? It's going to take some time to tell, and we'll probably not find out until he's next on Truth Social.
Yeah, and maybe we find out at the next few Fed meetings. Of course, the next one on July 30th, after that, mid-September, then late October, and then early December. Joe Mathieu, the co-host of Bloomberg's Balance of Power. You can catch him and his co-host at the top of the hour. We want to keep the conversation going right now because, of course, for CEOs out there and really anyone in the C-suite, this has been a year so far of a great deal of uncertainty, a great deal of volatility. The issues with the Fed, just one among many. Rob Hornby joins us right now. He's a co-CEO over at AlixPartners, a business advisory firm that helps companies navigate complex situations. All right, one of the most complex ones, of course, is what we just watched there with the president and the Fed chair. I am curious as to what you're hearing from folks in the C-suites about some of the political drama, because I've heard from folks in the market on Wall Street who kind of shrug their shoulders and they say, look, at the end of the day, the Fed is going to do what it does based on the data, not on political pressure. Are people in the C-suite, are they worried that maybe political pressure will start to seep in to Fed decisions?
I think CEOs are getting accustomed to issues every day. We can all think back, including me, to days when things seemed stable, where we made long-term plans, but that isn't the kind of world in which we live. So that's just one of many pressures facing CEOs and C-suites. Our survey, our annual disruption survey, tells us that actually people are getting used to it. They're less anxious than they used to be about it. And I think they're coming to terms with this being part of the job.
Yeah. And does that include, when you say they're less anxious, that includes the issues with tariffs as well?
I think tariffs are just one of many things, a particularly challenging set of issues for many companies. But of course, we had a pandemic, we have wars. We have a series of interlocking issues that are challenging businesses every single day. And the C-suite's job is to find a way through all of that.
There's sort of what I would call, I guess, the bad challenges and the good challenges. And one that I put in the good challenge bucket is kind of this explosion in technology, artificial intelligence and the associated technologies with it. On one hand, it's costing a heck of a lot of money. And I'm sure it's causing some anxiety as people try to figure out how to catch up or keep up. At the same time, there is a potential positive in this, assuming that this technology and the money that's being spent on it is deployed properly. Are you seeing that being deployed properly? Are you seeing the approach to AI as something constructive?
I think we're still earlier in the life cycle than people want to talk about. It's tough for CEOs because they need to be seen to be going up that curve. It's important. But on the ground, we're earlier than perhaps it looks. People are experimenting. I saw a stat the other day, 42% of pilots of AI are just abandoned entirely before they even get into live service. So we're still experimenting. AI in most companies today is not really at scale. But that's not to say that it's not going to be transformative, because I believe that it is.
The argument for the transformation is this idea that AI effectively will touch almost everything in our society in some degree or another. And some people are equating that to the Industrial Revolution, obviously the advent of computers in the 50s, 60s, and 70s. Is it that big? Do you think it could potentially be that big and that transformative?
I think it is that big.
Yeah.
And since you mentioned the Industrial Revolution, of course, that was a huge upheaval. It was very difficult to navigate, but it created more jobs than it destroyed.
Yeah.
That was the same for the internet. It's my belief that could happen with AI. It's always easier to see the jobs that might go than the jobs that might come.
Yeah.
And so I'm pretty positive about that.
But of course, when we talk about the Industrial Revolution, obviously probably the most famous quips are about the buggy whip makers and the stagecoach makers who got left behind. You did see a lot of job loss.
Definitely.
From the Industrial Revolution. You did see a lot of job creation as well, and obviously we know with the benefit of hindsight, on a net basis, job creation far outweighed, even on a per capita basis, of what we saw with job losses. Do you think that will be the same case for AI, that the net effects on the job market will be positive?
I do, and the reason, if we just take a little example, the internet effectively destroyed the physical travel agency industry, but it created 30 million web development jobs. Generative AI is in the process of disrupting them, but now we have prompt engineering.
Yeah.
I think we haven't seen very much of the new categories of jobs that are coming.
Where are those categories going to be? Because there's been talk about the labor market right now, particularly for entry-level people coming out of college, and that a lot of those entry-level jobs are kind of like grunt work that is, to a certain extent, being replaced by technology. If you listen to CEOs, they'll say this is a great thing. If you're someone coming into the job market, what's your entry point going to look like if those entry-level jobs are kind of overtaken by technology?
Well, someone has to manage these platforms. People need to curate them, they need to check them, they need to action things that arise from them. There's a whole series of human tasks around the platforms, and the platforms themselves require work. I think we should also just note that some of the physical tasks, AI is not coming for plumbers anytime soon. We could see a bit of a reevaluation of the way we value certain types of jobs because some things are not going to get automated.
With regards to how companies are deploying AI internally, are you seeing or hearing about any significant improvements in productivity?
People who are starting with the old style machine learning, it's been around for decades, it was underused, but it's a very mature technology. People are getting results out of that. Generative AI is newer, it's less mature, but there's real benefits in 3 areas. Content, so the way we create and edit content. Coding is absolutely built for coding. And conversation, because in the end, generative AI is a natural language platform. In those 3 lanes, we're seeing real differences. What we're not seeing is the replacement of whole jobs. It's not mature enough, it can't orchestrate itself for long enough without going wrong to take a whole job.
With the deployment of AI and the associated technologies, what are the geographic differences you're seeing? I'm talking like kind of on a continent by continent, region by region basis. Is this sort of a winner takes all, or are we going to sort of have a global sort of AI industry that's cooperative and not, at odds as it seems like today?
I think we only really talk about one race, and that's the innovation race. The United States is clearly leading that race, closely followed by China. Some of the European countries and others are also in that race. But the adoption race is actually a bigger race. That's going to be the unlock for productivity. Cracking the code on how to use the technology, wherever it was built, is going to actually be a bigger vector of value creation. So I think that's a race we should talk about some more.
All right, well, we have to have you back on to talk about it, Rob. Appreciate you stopping by. Rob Hornby, co-CEO over at AlixPartners. A lot of news crossing the wire post-market here, of course, including those earnings out of Intel, those earnings out of Deckers, a stock buyback over at Schwab, and that Pinnacle Synovus deal now confirmed as coming down the pike. But of course, the big news over the last 30 to 40 minutes was that tour that President Donald Trump took of the Fed building, the construction zone there alongside Jay Powell, and the interaction between those 2 men, the pressure that the White House has been putting on Powell and the Fed to lower interest rates. Joe Mathieu over at Balance of Power. He's going to take a deeper dive into all of this at the top of the hour. We want you to stick around for that. A lot of important things were said by these 2 men, the Trump White House, putting pressure on Jay Powell.